Welcome to Essential Biz Marketing. Global capital and currency markets play a vital role in connecting economies, funding businesses, and managing risk. This chapter explores how these international financial systems enable trade, investment, and long-term growth. This chapter begins by explaining why the international capital market is essential for expanding funding options and enabling cross-border investment. You will also learn about the three main components of this market: bond markets, equity markets, and euro currency systems. We outline how the foreign exchange market facilitates currency conversion, hedging, arbitrage, and speculation in global finance. We also cover how currencies are quoted and exchanged and examine the major institutions that operate within the foreign exchange system. Together, these objectives offer a full view of how international capital and currency markets function and support global economic activity. Let's look at Nintendo's transformation into a global gaming powerhouse. Founded in 1889 as a card company, it entered the gaming industry in 1989 and now produces hits like Switch, Wii, and DS. Nintendo disrupted the market with the Wii's wireless controllers and built-in Wi-Fi. Its Wii Fit program introduced fitness into gaming, and over 100 million units were sold worldwide. The Switch brought portability and home gaming together, making it highly versatile. Its massive popularity caused retail shortages, with systems selling out within hours. Nintendo's earnings are heavily impacted by currency exchange rates. A strong yen reduces foreign income when converted, and in 1 year, it lost 92.3 billion yen due to forex losses from 257.3 billion yen in total income. Let's start with the global importance of capital markets. These systems connect investors and borrowers across countries, enabling cross-border financial activity. Next, we explore its practical role. It expands the global money supply and allows access to funding beyond domestic markets. Access to global capital has cost advantages. Increased lender competition lowers interest rates, helping firms borrow more affordably. Capital markets also reduce risk. Diversifying portfolios across countries helps offset regional losses with global gains. When domestic capital falls short, global markets fill the gap. Firms and governments turn to international funding sources to meet their financial needs. What drives this market's growth? Technological advances, deregulation, and new financial instruments have accelerated development. Let's explore how markets turn illiquid assets into tradable ones. Securitization means converting assets like loans into marketable securities. The process involves pooling mortgages or debts, issuing securities backed by them, and selling those to global investors. Finally, let's look at key financial centers. Major hubs like London, New York, and Tokyo lead the market, while offshore centers offer tax advantages. Now we break down the capital market into three parts. Its core components are the international bond market, equity market, and euro currency market. Let's begin with the bond market. It helps companies and governments sell bonds beyond their home countries to raise international funds. Let's look at Eurobonds, a key type of international bond. Eurobonds are issued outside the country of the currency they're denominated in. For example, a dollar bond issued in Europe. Now let's compare Eurobonds and foreign bonds. Eurobonds are issued outside the currency's home country, while foreign bonds are issued by foreign entities in a domestic bond market. Interest rates shape global bond activity. When rates are low, more borrowers and investors are drawn to the international bond market. Next is the international equity market. It allows companies to raise capital by selling shares outside their home countries. Why is this market growing? Privatization, emerging economies, and digital stock exchanges drive global equity expansion. Investment banks play a vital role. They connect global buyers and sellers, facilitating equity transactions across markets. Now let's move to the euro currency market. It deals with currencies deposited outside their country of origin, like US dollars held in Europe. Why use euro currency markets? They offer lower regulation and costs, though they come with higher risk. LIBOR is central to this market. The London Interbank Offer Rate sets benchmark interest rates for euro currency transactions. Let's examine what the foreign exchange market does. It enables currency conversion and supports global business through hedging, arbitrage, and speculation. Currency conversion is its most basic role. Businesses convert money to pay foreign suppliers or receive payment from international customers. Hedging protects against exchange rate risks. Companies lock in future rates to stabilize revenues from international transactions. Let's look at how Hyundai uses hedging. On February 1st, its U.S. plant plans to remit $1 million to Korea, but the final amount in won depends on the exchange rate at that time. On January 1st, the exchange rate is 1,000 won per dollar. At this rate, Hyundai HQ expects to receive 1 billion won when $1 million is remitted on February 1st. If the exchange rate drops to 800 won per dollar by February 1st, the impact is clear. Hyundai HQ would receive only 800 million won, resulting in a loss of 200 million won from the original expectation. But if the rate rises to 1,200 won per dollar, the outcome improves. Hyundai HQ would receive 1,200 million won, gaining an extra 200 million won from favorable exchange movement. If the rate stays at 1,000 won per dollar, the result remains neutral. Hyundai HQ would still receive 1 billion won, exactly as expected, with no gain or loss. To avoid these fluctuations, Hyundai can use a forward contract. By locking in a rate of 1,000 won per dollar, the company ensures it will receive exactly 1 billion won on February 1st, no matter how the market moves. Another function is currency arbitrage, buying low and selling high. Traders exploit price gaps between markets to earn quick profits from exchange rate differences. Currency prices often differ across markets. In this case, €1 costs $1.08 in Japan and $1.10 in the United States, creating a price gap for potential profit. A trader buys €1 in Japan for $1.08 and sells it in the US for $1.10. This earns a profit of 2 cents per euro by exploiting the exchange rate difference between the two markets. Currency speculation is about betting on future exchange rate changes. Though risky, it offers traders the chance to profit by predicting how currencies will move. On January 1st, a London trader expects the yen to rise in value. At the current rate of 150 yen per £1, the trader uses £10,000 to buy 1,500,000 yen. By April 1st, the exchange rate shifts to 140 yen per £1. The trader converts 1,500,000 yen back into pounds and receives 10,714 pounds, reflecting a gain from the stronger yen. The final profit is clear. 10,714 pounds minus 10,000 pounds equals 714 pounds. By correctly predicting the yen's appreciation, the trader gains from currency speculation. Exchange rates define how currencies relate in value. They show how much of one currency is needed to obtain another in global transactions. A direct quote shows the home currency needed for 1 unit of foreign currency. In the US, $1.10 per euro means it takes $1.10 to buy 1 euro. An indirect quote flips the perspective. Instead of $1.10 per euro, it shows 0.91 euros per dollar, how much foreign currency you get for 1 unit of home currency. Exchange rates vary by timing. The spot rate applies to immediate transactions, while the forward rate is set today for a future exchange. Businesses use forward contracts to stabilize costs. By locking in a future rate, they protect themselves from unexpected currency swings and plan more reliably. Let's look at an example involving a U.S. company. It must pay 100,000 euros to a German supplier on February 1st and worries that the euro may strengthen before then. Under option 1, the company uses the spot rate of 0.91 euros per dollar on January 1st. To cover 100,000 euros, it would need to pay $109,890 immediately. Under option 2, the company enters a forward contract at 0.89 euros per dollar. It will pay $112,360 on February 1st to settle the €100,000 payment, regardless of future rate changes. A cross rate links two foreign currencies using a third one, usually the US dollar. It helps calculate exchange rates when no direct quote exists between two currencies. Let's look at an example of cross-rate conversion. A traveler in London wants to exchange £1,000 into yen, but since no direct GBP/JPY rate is available, the transaction must go through US dollars. In the first step, the traveler converts £1,000 into dollars at a rate of $1.30 per pound. This results in $1,300, which will then be used to obtain Japanese yen. In the first step, the traveler converts £1,000 into dollars at a rate of $1.30 per pound. This results in $1,300, which will then be used to obtain Japanese yen. Let's now shift to the institutions behind currency exchange. The foreign exchange market is decentralized, operating through a global network of commercial, investment, and central banks. In the interbank market, large banks trade currencies directly. These transactions help businesses and investors secure foreign exchange for international operations. Securities exchanges allow trading in currency futures and options. They offer smaller volume investors tools to manage exchange rate risk. The over-the-counter OTC market offers flexibility. Firms can negotiate customized currency deals directly with financial institutions, outside formal exchanges. Now let's explore how governments intervene in currency markets. Some impose exchange restrictions to stabilize their economies, requiring approval, limiting transactions, or setting multiple rates. These restrictions often protect weak currencies. They help prevent capital flight and maintain economic stability under pressure. Currency accessibility varies. Freely convertible currencies like the dollar and euro face no restrictions, while weak currencies often require official approval. In restricted markets, firms may turn to countertrade. By exchanging goods and services instead of money, they bypass currency controls and continue operating internationally. Let's wrap up with the key takeaways from this chapter. International financial markets are essential for businesses, investors, and governments worldwide. These markets support trade, investment, and risk management. They provide access to capital, stabilize currency flows, and enable global economic integration. Looking ahead, these systems must keep evolving. As technology advances and regulations shift, financial markets will adapt to new global challenges. To summarize, the international capital market expands funding and lowers risk. It's driven by tech, deregulation, and innovation, centered in hubs like London, New York, and Tokyo. Its components include bonds, equities, and euro currency. Each market offers global access to funding with varying degrees of regulation and risk. The foreign exchange market performs key global functions. It enables currency conversion, hedging, arbitrage, and speculation for firms and governments. Exchange rates come in several forms. Direct, indirect, spot, forward, and cross rates help firms manage timing and pricing in currency transactions. Key institutions power the FX market. Banks, exchanges, and OTC systems facilitate transactions, while governments may impose controls to stabilize flows. Thank you for joining us in this session. We look forward to exploring more global finance topics with you soon.